Welcome to FounderLine, the show where we answer your questions about startups. I'm your host, Joe Beninato. Thanks for joining us. It's great to have you with us today. Our goal with FounderLine is to provide a forum for startup founders and startup employees to get their questions answered. So whether you're in the midst of a startup and trying to figure out a situation with an employee or an investor, or you're thinking about starting a company, or maybe you've received a job offer from a startup company you're thinking about joining, maybe you're getting ready to go start your own company yourself. We're here to try and help you with those situations and to answer your questions. This is a live show, and we need you to participate. And the ways you can participate, you can call us to ask your questions. The phone number is 1-844-4-FOUNDER. That's 1-844-436-8633. You can email us. The email address is help@founderline.com. You can tweet. Our Twitter handle is @FounderLine. And if you are worried about being anonymous, you can go to our website, and there's a form there where you can submit a question as well. With that, let's get the show started. Our guest today is Ariel Poler. Ariel's an old friend who's an entrepreneur and an active angel investor. He's grown a number of companies, including iPro, Topica, and Textmarks, and served on the boards of many companies: Kana, Link Exchange, StumbleUpon, and Odeo, the precursor to Twitter. He's currently on the boards of Freedom Financial and Strava, and he's also a very big kitesurfing fanatic. So Ariel, welcome. Thank you for joining us on FounderLine today.
Yeah, thank you for having me.
So before we dive into the calls and the emails from everybody, I usually spend a few minutes just, so people can get to know you a little bit, walking through your background. So maybe we can go way back. I don't know if either of us can remember this far back, but iPro was a company in the mid-90s?
Yeah, 1994.
Yeah, so the earliest days of the internet, just as we're getting going. And how did that company, what led you to believe there was an opportunity in those very early days?
Yeah, so I was, this in 93, I wanted to start a company. I didn't know what to do. Somebody showed me the web, and it just clicked. I'm like, oh my God, this is going to be pretty big.
Yeah.
But what do? I try different things, and then it hit me. It's like, well, somebody's going to have to measure activity on the web.
Yep.
So I just started. iPro was the first web analytics company, and it was a little odd because at that time there was no marketing, there was no advertising, but to me it seemed like that was coming.
Okay.
And fortunately it worked out. I was a little early, but not too early.
Oh, good. And what was that, an acquisition or
Well, yeah, in the early days, the smartest people in Silicon Valley were telling me that I should go do something on AOL, that I should go to interactive TV. We partnered with Nielsen. It became Nielsen iPro, then we merged with another measurement company called Engage, and that company went public, and then after it was public, got acquired by somebody else.
Yeah, those were. I mean, I remember those days, and Mosaic comes out, and then Netscape, right? And it was just a mad rush. Like anything you can imagine was being built on the internet at that point. And
it was very special because there were so few companies. Yeah. So I remember every day I would go to this website called NCSA, Mosaic, What's New? And you could see what were the new websites that day.
Yeah, like
there would be
there were
three or four.
You could keep track of them, right?
So for a few years, actually, you could keep track of everything on the web.
That was awesome. And then I don't know if you took a few years off, but then the next company was Topica, and that's when we originally met. I forget who introduced us, but that was sort of 99-ish, 2000.
98, actually.
Oh, 98,
at least when I started it. Yeah,
okay.
yeah. So after iPro, I just went and spent some time helping a few startups as an active board member.
Okay.
You mentioned Kana, Link Exchange. And then I thought that it would be interesting to have email groups, and this was before Yahoo Groups or Google Groups.
That's right.
It seemed like something that would be useful, so I started Topica in 98 to do just that. It was, and the name Topica was Topics. The idea was that each of these groups would be around a specific topic.
That's great. And in fact, that's where I met Roberto Bonanzinga, who we're taking the show to London in a couple of weeks, and Roberto is going to be our guest.
It's a very small world.
Yeah, so it's all connected. And then, you know, spent some more time mostly investing these days and on the board of Strava. And this is the second time working with Mark Gainey, right? So
with Mark Gainey and Michael Horvath, the two co-founders who were the co-founders of Kana, which was enterprise software.
Yeah. We
had a really good time and worked out really well together back then. So when they were doing their next company and they reached out, I was delighted to work with them. And again, it's doing really well, and it's a great experience.
And tell us about Strava. Like I know a lot of people will know about it, but
yeah, I mean, if you're a cyclist, I'm sure you know it, and if you're a runner, there's a good chance you know it. It's a platform for a network, if you will, for cyclists and runners to share their rides or their runs with their friends, with their community, and also to measure themselves, be it against themselves, against others. Some people take it more seriously and really want to be in the top of the leaderboard. For others, it's more about sharing with their friends how they're doing and motivating themselves. And yeah, it's wonderful. I have to be careful when I wear the Strava gear, because so many people are so passionate about it that if I'm on a ride, then people will stop me and want to talk about Strava.
So
which is good.
You cover it up so you're stealth Strava, huh? Well, that's great. Why don't we take some questions, and we'll see if we can help some people out. So let me fire up our stuff here, and we have some emails that are coming in. So the first one is from Tom, and it says, "How do you find your investments?" So this comes up a lot with investors. Like, you know, are they over email? Are you out scouting for them? Like, where do they come from?
Yeah, I mean, I'm in the fortunate situation that I've been investing now for almost 20 years. My first investment came from when I was running iPro, and it was high profile, and I was speaking a lot of places, and very frequently some entrepreneur would say, "Can I ask you for advice?" And I always try to be helpful, and then sometimes those people then would do financing, and then if I got to know them and like them, then I would try to put, back then it was just a little bit.
Right.
And that over time, it just grew to the point where you're helping or working with more and more people, and if they like interacting with you, then they will tell their friends about it. So the other day I was looking at what was my #1 source of projects, of deals, if you will. And it was the people who I had met and I had turned down. And initially you go like, the ones I turned down, but the reality is most investors turn down 10 times or 20 times more deals than we can invest in.
100, right?
So there's many more of those. And what I try to do is I try to be helpful always. And so then they might tell their friend or the second time around that they're doing something, "Hey, Ariel, didn't work out with that previous company or with my company, but maybe this one." So that's a big source. And then, of course, these days, people that I've worked with in the past, a lot of either them or their friends.
Yeah. So the people who you had previously turned down, is that like more than 50% of the investments you make, or?
Oh, it's a good question. I'm not sure what the actual percentage is, but it's definitely a good percentage of the potential investments that I get.
The traffic coming in.
Yeah, absolutely.
Okay. All right, great. All right. Well, here's another one. Speaking of kite surfing, from an email from Nick. Kite surfing seems to be growing in Silicon Valley circles. Why is that? Seems like we went through, you know, it's kind of a biking, maybe there's golf like in the 70s and 80s or something, and then biking and kite surfing, you know, Bill Tai with Mai Tai.
Sure.
And so what's going on? I'm not part of that community, although I was down in Mexico recently and saw some amazing stuff going on. So
well, definitely. You know, the Mai Tai, which is an organization that originated here with Bill and Susie in, you know, Silicon Valley, has helped. And in general, I think it's an activity that is somewhat consistent, if you will, with entrepreneurship. There seems to be, if you're an entrepreneur, you go head on, you work really hard, you focus on it. And I think there's some aspects of kite surfing that are similar. I think the flip side of that is, kite surfing, what I like most about it is when I'm doing it, I cannot think about anything else, because you have to be focused, otherwise, you know, you take a fall or what have you.
Yeah.
And when you're an entrepreneur, you're often working pretty hard. So you need that escape, and I think kiting works really well in terms of, okay, I go kiting and that's where I clear my mind. It's almost like meditation. I've heard other people talk about the fact that kitesurfing tends to be a very social activity, even though it's not obvious. We usually need to help each other land our kite, launch your kite, watch after one another. So in that sense, it's also like most startups, you need a lot of people to help you out and so on. Finally, it's like many things, they start to get traction in terms of in a community. People see it, we encourage one another, we help one another, and that's helped it take off.
That's great. Well, I'm going to have to get out. I saw these guys jumping over waves, and it just looked like so much fun. And I'm sure that's an advanced maneuver, but...
I'll say the following thing about kitesurfing. It looks very intimidating, but it's not difficult.
Yeah.
So that's, which might be similar to entrepreneurship, which is once you go in, anybody can do it. You just have to go for it.
Yeah.
And I think kiting is like that.
Yeah.
Anybody can do it.
It looks really fun, and hopefully my shoulder is healed enough to withstand that. All right, so here's another one from an anonymous one. I think I see why that is. My co-founders and I have received 2 term sheets for our Series A. What are the most critical factors in deciding which investor we should work with? And this is a great question because a lot of times people focus just on the numbers, but there's so many other things to look at as well.
And I've been obviously with the companies that I was a founder of. I went through both friends and family. I did angels. I did VCs. I did corporate. For me, the first thing I would say is very personal. I don't think there's a generic answer, and I don't think what's important for me should be important for everybody. So you have to, as an entrepreneur, you have to find what's the most important thing for you.
Yeah.
I will say for me, I remember at the case of Topic, I was undecided between 2 VCs, and I separately had them over for dinner at my house with my wife. And the short version is like, who do I want to have over for dinner, and who do I want to spend most time with? Because once you partner with an investor, it's even more solid than a marriage, because you can divorce.
Yeah.
But it's not that easy to divorce from an investor.
It rarely happens.
So I think the most important thing is which individual. And this is very key. It's not about the firm. It's not is it firms X or Y and who has better reputation. It's which individual do you have the better chemistry with, do you think you're going to get along with, do you think can be most helpful. To me, that is really...
Like that's number one above valuation
by far. I think that, and then what you tend to see is that the better, more sophisticated, more experienced investors tend to give more simple term sheets without too many caveats and without too many clawbacks and things like that. Right. So a clean term sheet that is simple. I mean, when entrepreneurs, when I'm on the other side looking at investing, sometimes entrepreneurs want to give me every detail, and I just say, look, so what's the valuation? And then there are a few key other things that tell you, is it a simple terms or is it convoluted? So the best possible investor, clean terms, those are, I mean, without getting, it's hard to know then sometimes the little details.
Yeah, no, and it is hard because I've experienced cases in my life where maybe the valuation is much higher, but you want to work with the other person, and I tell people in those cases to try to maybe they'll come up a little bit, and so they can close the gap. But ultimately, like you're going to be spending a lot of time, and this person, they need to be your advocate and your partner moving forward, and so. That even at dinner, you can only learn so much at that time. The best thing to do is work with people like you have with Mark, right? Where you know each other.
Well, and what I do actually many times is before I decide to invest, and definitely before I would join the board, is I'll spend time with the entrepreneur in not doing due diligence, but actually just having working meetings. So after the first meeting, I will say, okay, I want to spend a little bit more time with you. What is the challenge you have? Well, we're having a pricing. Okay, let's go have a meeting and discuss pricing.
Yeah.
So try to spend time with the potential investors.
Oh, good.
References, which is the same as for hiring employees. Talk with entrepreneurs that have worked with both potential investors, and try to get not the ones that, ideally maybe not the ones that they're currently working with and know them well and might not give you
the ones they fired or they...
well, hopefully they haven't fired too many, but at least the ones they worked with in the past or who you think are going to be more candid.
Yep.
Absolutely.
No, that's great. Well, good. Once again, we want to hear from you. So call us. The number is 1-844-4-FOUNDER. You can email to help@founderline.com, or you can tweet to @FounderLine, and we'll see if we can help you out. So let's keep going with our questions here. Let me see what we have here. Okay, we have a question from Larry in Yuba City. What target IRR are you looking for when looking at an opportunity to invest? Does that number differ inversely with your assessed likelihood of the company being successful? Interesting.
Yeah, so I mean, the first part of my answer would be that, so I'm here in Silicon Valley, and Silicon Valley is a very different world. And the way we do things here tends to be different than the way
New York
they're done
or wherever.
in most places.
Yeah.
It sounds like that question comes from outside Silicon Valley.
Yeah.
So what almost everything I say applies to Silicon Valley, not always to outside Silicon Valley. And
Okay.
I think that the way I think about it is I want to be involved with an awesome company where, for me, I look at it the same way as I was encouraging the entrepreneur to look at it. For me, the entrepreneur is the most important. I don't want to invest in a company, no matter how great it looks, if I think I'm not going to enjoy working with the entrepreneur. So
Yeah.
do I really enjoy the entrepreneur? Do I think it's a product or a service that's going to have great impact, that is really meaningful and worthwhile getting involved with? And then, does it have the potential to be huge? So I don't think about this IRR or that IRR. And I think most investors here in Silicon Valley don't think about it that way. We want to be involved, like in my particular case, I'm a seed investor. So I usually get involved, valuations are 5 million, 10 million, maybe a little bit more, maybe a little bit less. I'm in there and I want to get involved with companies that I think can be humongous, like hundreds of millions, billions.
Right.
I'm not trying to say, am I going to get 10x, 50x, 100, a lot,
Right.
A big X. And if you have that, and if I like the team, and if I feel I can help, that is what I focus on.
Yeah. That's great advice.
And risk is not a problem. Actually, risk is good. I hate it. I don't like it when an entrepreneur gives me a pitch that says, well, there's a safety net, worst case scenario, we sell it or we do this. It's like most investors, I mean, we invest in multiple companies. It's okay. We know some of them are going to fail. So I'm actually not interested in mitigating the downside. I'm
Right.
interested in the upside.
Yes.
So risk is good. Now I want to believe that, or I have to be convinced that there's a decent chance that upside is going to materialize. That's really what matters.
Yeah, I think especially on the East Coast, there's more of a focus from the finance community on things like IRR, and I think it's a little hard for people to understand out here. It's, and part of this is you having fun, right? Like I'm assuming you do this because you like doing it, and if you're even if it's a huge opportunity, if the CEO is like a total asshole, you're probably not going to be too interested in working with those
Which
guys.
is really tough because without naming names, I have passed on some amazing projects in Silicon Valley because I'm like, oh, this is going to be huge. But
oh, come on, name some names. Come on.
I just don't want to work with this person.
Yeah.
And I'll give you the positive one, not the name. And yeah, it's a tough one, but that's true. I mean, life's too short.
Yeah.
So.
Yeah, exactly. All right. Well, great question, Larry. Larry is one of our regulars, so he, I think every week so far, he's either tweeted or emailed or something with a question. So here's the one that just came in from Jonathan in Emeryville. I see a gap in the marketplace. A few other companies have had similar yet unsuccessful attempts. What are your thoughts about launching a company into a space where there have been multiple entrants but no successes?
There's so many examples of huge successes that have that kind of description, where a lot of people have tried and nobody has quite nailed it.
Yeah.
So to me, that's it's actually not a negative nor a positive. It's but definitely not a negative. Now I would need to understand what does this new project have that is different from the ones before.
Right.
Is there something about the environment that has changed? Maybe before when they tried it, not as many people had mobile, or not as many people had broadband, or the marketplaces weren't as developed. You couldn't rely on this or that existing company, or maybe the team is so much better. So I would want to see why is it that they're gonna be successful. The truth, though, is that for us early stage investors, it's so hard to know what's going to work and what's not going to work. It's just really, really hard.
I think of some recent examples like DoorDash. I thought there were like 10 companies doing food delivery, and they seem to have broken out, at least locally here.
Yeah.
I don't know how widespread it's been. Or there's the laundry service, I think it's wash.io.
Yeah, they just did a big race.
And there were a couple of other laundry ones right before that didn't seem to go anywhere, right?
It's very true. And sometimes, and I'm not intimately familiar with those too, but sometimes you see that somebody there's something about the way they're doing it that it's better.
It strikes a chord with
people. And
people.
It strikes a chord, and they're really nailing it, and you go, this is going to work. Sometimes it's just more, it's more about the timing. Sometimes more often than not, it's luck.
Yeah, yeah. No,
so you got to get lucky.
You can never, you never know what it's going to be. The other thing that I think has been interesting is a number of ideas that like failed way back in the 90s or early 2000s, like are coming back again.
Well, Groupon is a perfect example.
Yeah,
I mean, so many people tried that before until they succeeded with it.
Yeah, and so I always tell people, I get approached a lot about my last company, Tello, which was in the mobile feedback space. And I've probably had, I don't know, 20 entrepreneurs who have similar products reach out and say, you know, it looks like it didn't go so well, so should we try it? And you know, I think first you got to understand what's different about what they're doing. Maybe we didn't, you know, try everything, but I think there's always a chance to go back and try it again if there is, you know, a different aspect. So depends. All right, well, let's see here. Here's another one from Yvonne. What are some of the biggest mistakes you see startup CEOs make?
It's a big question.
Yeah,
so many things. I mean, I think one that comes to mind is that they're not working on something that they're really passionate about, but they're working on something because maybe they see an opportunity in the marketplace, but it's not an area they're crazy about, or maybe they're doing it because they think they're going to do really well financially, but not because that's what they want to spend their time on. And it turns out that it's so unpredictable. It's funny, just yesterday I heard a quote from Jim Carrey, which I'm going to paraphrase, but it said that no matter how safe you try to do something, there's always a chance of failing. So you might as well fail at something you love. And any startup is very risky. So to me, the only way to make it a win-win is to go after something you really love, something you want to spend your time on. And that's also particularly important because more often than not, you don't get it right initially. But if it's an area that you care about, it's a problem you want to solve, an opportunity you want to take advantage of, then you keep iterating and iterating, and you're enjoying it because you care about it. What I've seen sometimes is an entrepreneur sees an opportunity, tries it doesn't work, but they were not particularly attached to it, so they immediately pivot into something else and immediately pivot into something else, just chasing the latest opportunity, the latest fad.
Yeah.
To me, that would be a mistake. Another one that comes to mind is not focusing on your biggest risks. And an example of that would be an entrepreneur that's too worried about secrecy. Because if I say it, they might copy me, or too worried about maybe giving too much equity, or not realizing that their biggest risk is that the company's never going to go anywhere.
Right.
So they should focus all their energy on how do I minimize the risk of not moving the company forward, as opposed to how do I minimize the risk that somebody steal my idea.
Yep.
Somebody once used the analogy, it's like you're in a plane and it's crashing, and you're worried maybe about some cancer that might develop. It's like, you know what, you're gonna die from a crash. Worry about getting a parachute. The cancer can wait.
Yeah.
So that would be
reshuffling the deck chairs on the Titanic, right?
Yeah,
Isn't that
some of that.
Yeah. Well, sometimes it's hard. I mean, a lot of people who do these companies are they focus on the details and they understand those things. I do that to some extent, and I think over the years I've learned, if you can land that one employee, yeah, maybe you have to give them 3% because they're the key engineer, or they're going to make the difference on the marketing front, or whatever it might be. At the end of the day, if the company's worth zero, they get 3% as zero, right?
Exactly, and that's the most likely scenario.
Yeah.
The most likely scenario is the company's going to be worth zero.
Yeah.
So don't worry too much about whether you end up having 10% or 15%. Worry about maximizing the chances of that not being zero.
Yeah, make it worth 10 billion, and then you really don't care if it was 10% or 11%.
Or even if instead of, it doesn't need to be 10 billion. Maybe maybe it's not huge. Maybe you cannot retire from it, but you have a good experience, you learn, you make good contacts, then you go and do another one.
Yeah, yeah. No, that's great advice. Well, we're gonna take a moment here to thank some of our sponsors. So relax for a minute, have a deep breath. You know, this show wouldn't be possible without the great support we receive from our two sponsors, Ustream and Orrick. And I'll start with Ustream. You're probably watching this over Ustream right now, and the team over there has been fantastic to work with. We originally reached out to Brad, who's the CEO, and he loved the concept of what we were trying to do, trying to help entrepreneurs, and immediately got us involved with his team. And we primarily work with Alden and Warren over there. And just this past week, I had another conversation with Alden. We're going to be doing some remote location shows in a couple of weeks, trying to work out some of the details. And it's kind of amazing that you can have this, you know, TV production studio in a box on your laptop and go out and broadcast it worldwide. So they're the best, and you know, high def, everything you need. Setting it up was really straightforward. Took us about 10 minutes to get the first broadcast going. So if you are thinking about broadcasting a live event or a meeting or whatever it might be, go to ustream.tv and you can find out more information there. I'm sure they'll be just as helpful to you as they have been to us. I'd also like to talk a bit about Orrick. So Mitch Zuklie is an old friend, and you know, we've been working with them on previous companies as well as now on FounderLine. And you know, the whole team over there is just fantastic. When you're thinking about doing a startup, you want to surround yourself with great advisors. And even though you want someone who understands the law and can take care of the contracts and sort of the nuts and bolts, the bigger role that your lawyer plays is as one of your key advisors who has seen so many more financings and acquisitions and hirings and firings than you'll ever see. And so having that institutional knowledge and being able to share that with you and give you examples of what the going rate is for something, if you're doing debt financing, for example, or whatever it might be. So, you know, it's been great to work with Orrick once again on FounderLine. And if you want more information, you can go to orrick.com, and I'm sure they'll be able to help you out. So now it's time for a segment we like to call Ask the Lawyer. And you know, I just was talking about Mitch Zuklie. So every week we're very fortunate to have Mitch with us live by phone. Mitch is the chairman and CEO of Orrick, and hopefully he's on the line. Mitch, welcome to FounderLine. How are you?
Doing great, Joe. How are you?
Good. Welcome back to the continent. I know you've been flying around the globe, doing all sorts of crazy things. So thanks for taking the time today.
Thrilled to do it, Joe. Great to be back here in the States.
So, so what we'd like to do in this little segment here is cover a legal topic that's relevant to startups. And every week we pick something different, and we've got, you know, both Mitch and Ariel here to help out with their perspective. And today's topic is corporate structures. So there are a number of ways you can set up a corporation when you're getting going on a company. Pros and cons to each of those. And so maybe we'll start off, Mitch, if you could offer a little bit of an overview of the main corporate structures and maybe a few of the pros and cons, and then we'll get some thoughts from Ariel after that as well.
You bet, Joe. I'll be glad to. Let me start by saying that choosing the right business structure really depends on your business's stage and your goals. And there are three kind of main ways to go. The first is to be a C corporation, the second an S corporation, and the third is to do an LLC. And I'll start by saying that about 98% of the clients I work with are C corporations, or at least they end up being C corporations. And that's for one good reason. It's that VC firms are fairly insistent on investing in C corps. And a C corporation is what we think of as a plain vanilla corporation. And it's because it's plain vanilla and the investors know the basic rules around what it means to be a director in a corporation. They know the formalities to follow, that they feel most comfortable investing in it. There's another type of corporation as well called an S corporation. And an S corporation is an election that you can make in order to have your corporation treated as a pass-through entity, which basically means that the shareholders are able to pass company losses to their personal income reporting. There's conditions around when you can make that election, and there's certain states that recognize it, and I believe some that don't. But at the end of the day, an S corporation gives you some benefits while you're small and before you've raised meaningful amounts of outside capital. I say that because there's limitations on the structure you can have in order to qualify as an S corp. You cannot have a preferred stock and a common stock structure. So therefore, once you get a pretty meaningful amount of investment in it, will no longer work. The final structure at a high level is called the LLC. And the LLC is one of those things that I think from the standpoint of someone who wants absolute flexibility is the best. You can effectively do more things with an LLC than you can with any other structure. So it gives you great flexibility in terms of what you do and how you allocate losses and income and all kinds of other things. The one thing I think that you can't do as well with an LLC as a corporation is grant stock options. So again, once you become a company that's got lots of employees and you're working with stock options, there's some limitations, and for the sake of brevity, I won't get into them. It's not a perfect vehicle to create incentives for lots of employees. So let me pause there and see if Ariel or Joe's got other thoughts.
No, that's very helpful. So you see a lot of companies that come in, and some probably not even incorporated, others
Many.
that maybe have set up. So what do you say to, let's say it's clean slate, they haven't done anything yet. What do you typically suggest they do if they ask?
Yeah, I mean, for the vast majority, I think Mitch did a really good summary. For the vast majority, particularly if the plan is to eventually raise venture financing or professional investors, then the C Corp it makes the most sense. And it used to be that maybe it was a little expensive and complicated, but now it's been streamlined to the point where that's relatively straightforward. And I often encourage entrepreneurs who haven't incorporated maybe to sometimes even wait until they need to, especially if things are moving quickly. There's one case in which LLCs do make a lot of sense, and that is in companies that are going to be cash flow positive, or I should actually say profitable early on. And then in that situation, C corporations tax you twice, because you pay corporate tax, and then if you have to distribute funds, you pay tax again. Okay. Now, that's not a problem if the outcome is going to be an IPO or it's going to be an acquisition. But if you want to pay dividends, if this is a company that maybe is not raising a lot of money, but it's going to be cash flow positive, not that typical in Silicon Valley, but I will say I am on the board of a company. I'm involved with a company that it's very, very successful. It's been very profitable, and it's an LLC, and for that particular reason. So that's the one situation where the entrepreneur needs to be careful. If they're involved with a company that they anticipate will be profitable early on, then they should think hard about the LLC. And going from an LLC to a C Corp is not that complicated, but the other way around is.
I see.
So that's something else.
And in that case where it's an LLC, so they don't have stock options?
Actually, they do. I mean, it's doable. It's not as easy. It's more complicated, and often you'll see complicated structures where one company owns another company and so on. So it's not that you cannot do it. This guy actually have it. They have hundreds of employees, but it's not as easy as it would have been with a C Corp, but it's worth it because of the tax benefit.
Got it. And Mitch, any advice you give to the companies coming to you, either in the case where they've done nothing already, or if they've already set up in a certain way, if they're thinking about raising money from investors? Let's take the case where they're not profitable and they're getting ready to go raise some money from angels, let's say.
Joe, it depends a little bit on their individual facts and circumstances, and so it's always good to talk to a lawyer or an accountant before you pull the trigger. But the overwhelming thrust of my advice is keep it cheap and keep it simple. And as a result, an overwhelming majority of folks benefit from going to a C corporation and staying with it. Again, there's individual circumstances that sometimes suggest you want to do something different, and Ariel pointed out a good one. But the one thing to keep in mind is that you want to keep your transaction costs down. And I've seen a lot of folks who have really wanted to optimize for tax savings down the road or other things. It goes to the earlier comment you were making about really focus on what's going to make your business successful. And I think quite frankly, the most important thing you can do at the early stage of the enterprise is to focus on building enterprise value. Don't spend a ton of time, energy, effort, lawyer fees, or time on optimizing structure. Just go with a C Corp in most instances. Check with someone first to make sure that makes sense, but go with the path of least resistance. Plain vanilla is often your friend, and I think that you can waste a lot of time, energy, effort, and money by trying to optimize. So the overwhelming majority of cases, I think that will be a good choice.
All right, great. Well, thanks, Mitch. That's Mitch Zuklie from Orrick, and we have him here every week. We'll talk to you again next week.
All right, Joe. All right, Ariel. Have a great rest of the segment. Talk to you guys soon. Take care.
All right, thank you. And so thanks to Mitch for joining us once again. If you have a question for us, give us a call. The phone number is 1-844-4FOUNDER. You can email us to help@founderline.com or tweet to @founderline. So let's see if we've got some more questions here, and we'll dive back in. So let's see. Thomas sent an email, and it says, "We're raising an angel round. Is it better to have fewer angels putting in more money or more angels putting in less money?" That's an interesting question.
Yeah, unfortunately, the answer is that it depends.
Yeah.
Usually, you don't want to have, and I don't know what fewer and more means, and it depends on the amount.
Doesn't say, yeah.
But you ideally don't want to have dozens of investors, of angels. It can get complicated, and also nobody might have a lot at stake or a lot of responsibility. On the other hand, if they're value-added individuals, having a handful is great. I mean, what I see, the sweet spot, I would say, but again, it's hard to generalize.
Yeah.
But anywhere between 5 and 10 seems to me like a great number.
Yeah.
Sometimes a little bit more, particularly if you have 5 to 10 that are the core of your financing. Let's suppose that, I don't know, you're raising $1 million. And that between 5 and 10, they get you $800,000. And that's the bulk, and maybe you have 1 or 2 that have more. But there are a few strategic individuals that maybe put 10K or 25K, but you really want them involved. They have some expertise, they have some connections. That could be really good. But yeah, it's somewhere in the middle is the thing there,
yeah,
the short answer.
I think my last company, we had 15, including some institutions. And it did get to be a little bit of a challenge just because I felt guilty like not being able to talk to all of them regularly, right? It's just not possible. If I spent my time talking to 15 investors once a week, I don't get much else done. So in those cases, I would do an email update, kind of monthly, talk to a few of the key, if someone's on the board, obviously you're going to be talking to them more regularly, or maybe the largest investors. But some of these party rounds where I think it's 20K times 20 people starts to get pretty messy, right? And
it depends also on how the entrepreneur manages the situation.
Yeah.
If the entrepreneur is proactive about, you can stay in touch with everybody, like you say, by giving an update, and then individuals that have specific value added, you reach out to them. If you have to, you don't. If you don't, also setting up expectations up front is very important. So you don't want to take an investor who, for example, is not sophisticated and is expecting it's going to give you a tiny amount of money and expect that you're going to meet with him or her every week.
Right.
But if this is a sophisticated person who understands that they're just putting a little bit and that they're going to be helpful to you when you need them, then that works.
And those are the best investors, right? The ones who don't call you every week for updates, but they're there when you need them, right? I need some help with this problem or whatever.
Yes, although I will say that it's good to have diversity in your investors and in your board. So I think it's great to have those who don't bug you but are there when you need them, but it's also good to have a few that are more proactive, that are going to reach out to you and say, hey, how's it going? Do you need anything? I just came across this, I just came across that. So it's, I think sometimes talking about mistakes that some entrepreneurs make, sometimes I see in the Valley that some entrepreneurs feel that the less that they interact with the investors and they're bored, the better. They just want to be left alone. They just want the money because most investors are not value added. And in generic terms, they might be right, but ideally you do find some value added people and you leverage them and you interact with them. And,
yeah. No, that's a great point. I think diversity in the board or the investors, in the employees, in the management team, whatever it might be, I think, introverts, extroverts, whatever you might have. That's great advice. All right, so here's another one from Alex. What is your opinion about some of the online services like Kickstarter and Indiegogo? Are those a valuable or a viable way to launch a product? Have you ever been involved with a Kickstarter investment or any of those?
I have, yeah. I'm an investor in Boosted Boards.
Oh, yeah. The skateboards.
The mini Tesla.
That's right.
It's amazing. Those guys are incredible. I mean, they blew me away. I'm like, oh my God, a Tesla, but the size of a... and they did a very successful Kickstarter campaign. And I also I know the Indiegogo guys. And yes, I mean, it's definitely viable. It works well for market research to learn a lot. It can give you some PR. You need to be careful. It can put a lot of requirements, and sometimes you get a customer who prepays a little bit, and they expect that you're going to answer all their questions all the time, and you might have hundreds or thousands of these people. So you need to be careful. And I think the most important advice that I've heard from people who've done a lot of this kind of campaigns is you need to be ready. You need to, don't do it prematurely. Make sure you have your act together before you go and do one of those campaigns. Don't expect, and the other thing to remember is for hardware and such kind of products, it's likely going to take a lot more money than what you raise on Kickstarter.
Right.
So don't, in all likelihood, in most cases, it's not you do that and that's the end of it. But it could be a good way of getting the ball rolling, learning from the marketplace, getting feedback. In general, I think it's a tool that, if well used, it's very helpful.
And in the case of Boosted, did you invest first and then they did the Kickstarter or Indiegogo, or was it the reverse? They had done it already and gotten some consumer reaction. Which one came first?
No, yeah. For me, I met them actually through a common acquaintance that knew them. So it was not because of. So it was before the Kickstarter campaign.
Okay.
Although I believe they continued to raise money after, if I'm not mistaken.
Okay.
Because there was a lot of interest, and I believe that led to some great value-added investors, which were good to have on board.
I've seen some of both. I've seen some where they've raised a little bit of money and then they get a little more refinement on what it is they're doing. Then they go do the Kickstarter.
Right.
And I've also seen vice versa where, this cool thing comes out of nowhere and they raise $1 million to build the next whatever. There's a pretty cool cup today. I don't know if you saw
it. Oh, yes, I did.
Vessel, I think it was called. And it was, I'm pretty sure that was, I don't know if that was angel funded or VCs or Kickstarter or what, but these things can come out of nowhere, and then all of a sudden investors are knocking on their door because they see it as a great opportunity.
Right, it's a great validation. If you get all this great traction in Indiegogo or Kickstarter, then the investors will pay attention. The flip side, if it doesn't do well, then you get that feedback, but that doesn't necessarily is advertised to everybody, so you can take those learnings and try again.
Yeah, I remember back when we used to do direct mail. Remember those days?
Oh, yeah.
One of the things you can do with infomercials is actually create the infomercial before you create the product. And if anybody calls, I don't know if you remember, some of them say takes 14 weeks, for shipping, right?
Yeah.
And it's literally they're waiting to get the green light before they flip the switch at the manufacturing plant, whatever it is. So a little on the borderline, I would say, but it's now it's almost institutionalized with these Indiegogo and Kickstarter, right? Where you can have an idea and people pull out their wallets. The coin credit card thing is another example where it was sort of like, you know, they got validation, lots of people signed up, and next thing you know, they're building it. So that's pretty cool. So hopefully that helps, Alex. Let's see, we have an email from Sunil. At the very early stages of our company, should we do a convertible note or an equity round? So this comes up all the time, right? And people have all sorts of different opinions. I'm guessing you've done some of both.
I've done both. Personally, I don't think it's that big of a deal. I think some people are somewhat religious. It's like, oh, it's convertible is so much better, and some people will say, oh, no, we won't do convertibles.
Right.
Again, for me, I want to work with the best possible entrepreneurs, and I think both kind of work. I will say, again, you got to keep it simple. I think Mitch's advice was spot on. Don't get too complicated. So either way, don't do a financing that has too many. And the one thing I will say is very important if you do a convertible to have a reasonable cap. What I will not do is a convertible without a cap, because then my interests are not aligned with the entrepreneur. Because if there's no cap, which means that I'm just going to convert at whatever the next round valuation is, then why do I want to help the entrepreneur create value and get a really high valuation if that's what I'm paying?
Right.
So as long as there's a cap, then our interests are aligned. And now there's this new safe vehicle that some people are using.
The Y Combinator safe.
Exactly. Yes. I've done some of those. I personally don't think it's that big of a deal, one or the other. What I would say is focus on getting great investors, and then find out if there's a strong preference among the investors for one or the other. Maybe you do that.
What do you say, is a reasonable range for the caps these days? It tends to kind of ebb and flow with the craziness of the market. So what are you seeing that's typical these days?
So, I mean, typical that I see, and let me put Y Combinator aside, because Y Combinator's companies seem to be in a sort of like different universe for some reason. But I mean, it's very typical. Many of the deals that I see where there's $1 million going in at a $5 million cap.
Okay.
$4 to $6 million. Then if they're maybe a little farther along or the team has a little more experience, you might see that be $7, $8 million cap. And then you see the Y Combinator deals that tend to be more in the $8 to $15 million.
Really?
Yeah.
Any uncapped or?
No, always cap.
Okay.
Almost always, yeah, always cap.
Wow.
Yeah.
So, and is that pretty like across the board? Like the YC companies are up there, 8 to 15.
That's what I have to say. That's what I've seen.
Huh.
Personally, I don't care as much.
Okay.
Going back to, I want to find the great project, the great team, and that I think is going to be incredibly valuable. I'm going to have a great time. It's going to be a good experience. So at the end of the day, if it's 8 or 18. As long as I feel that it's not ridiculous and that there's other investors that are comfortable and so on, I'm less sensitive to I know there's some, I might be in a minority. I know there are plenty of investors who say, oh, if the cap is more than X, I cannot make my numbers work and so on. Right. But I don't work.
I think what I found is individual angels seem to have a little more flexibility.
Right.
If they fall in love and it's 15 is the cap, they're going to do it, whereas the people who have the seed funds or the whatever the current name is, if they have a rule, I can't go above 8 pre because then the numbers don't work, and I like to put in 150K or whatever it is, that gets a little more challenging.
Yeah, I mean the thing to keep in mind, I think for investors is that it's a power law that's in effect, meaning that usually for most investors, your most successful investment is going to return more than all of your other investments combined.
Right.
I mean, the ones, particularly for consumer, enterprise is a little less so, but for consumer it's very much the case. So for if you miss that one because the valuation was 18 instead of 12, then that would be pretty unfortunate.
Yeah.
Right?
Well, and those are the cases also where the personalities come into play, right? Like you mentioned earlier, you've missed some big deals, and in those cases it wasn't necessarily the value, maybe the valuation was also a problem, but it was more about the people, right? And
those are tougher for me.
Yeah,
those are definitely more difficult.
Yeah. All right, well, great. So let's see. We've got another one here from Paul. This one's interesting. My co-founder and I are no longer getting along. Happens, right? It definitely,
I've
definitely
done
happens.
so much marriage counselor to co-founders. I don't.
Different views on where we should head, hiring decisions, etc. We both want what is best for the company, employees, and investors. How do we resolve this? So I've been through this. It comes up all the time, and the marriage analogy is really a great one. It's like, how do you have an amicable divorce without splitting the kids in half?
Well, I mean, the first thing I would say is do it fast. Don't let it linger, and that applies as much to co-founders that have realized they're not working well together as they do to an employee. If you realize there's an employee who's not working out, don't let it linger.
Yes.
Just move quickly. It's painful, but it only gets worse. So whatever, deal with it quickly. And it's hard to know without knowing the specifics.
Sure.
But
sure.
in most situations, if they can work well together, then you have to decide, well, maybe one of them needs to leave, the other one stays. You decide maybe it's obvious, maybe it's not, who leaves, who stays, and then you try to have the person who leaves remain. Ideally, they can remain involved in a friendly fashion in advisory capacity. Maybe they're on the board, they stay on the board, they support the company, but the other person is maybe the one who's there day to day. So, at a generic level, I don't know what else to say other than deal with it quickly, be definitive, and usually everybody knows about it already, and it's lingering, and even if it's painful, people are going to be relieved afterwards. Oh, finally did something about it.
So is that something that you as a advisor or a board member can get in the middle of that and sort
absolutely.
of potentially help out? And
the type of role that I try to play is like I'm an extra co-founder that is there to help with whenever it's needed.
Okay.
But I'm someone who is hopefully trusted, and someone that the founders or the founder can come to when they need help with things that maybe they cannot get discussed with their employees, maybe they cannot discuss with their investors. Even though I'm investing, I'm usually trying to build a relationship more as a mentor of a sounding board.
Yep.
And so that I'm like, it's a common thing that if there are issues between founders, there are not too many people they can discuss it with. So I'm sometimes the one who does it.
The startup whisperer, right? when the issues come up. All right. Well, hopefully that helps. As Ariel said, it's a little hard, Paul, without having all the details. But hopefully that helps. Again, this is where having great advisors who can help you out, who you trust, whether it's your lawyer or one of your angels, that's really critical. So here's another one from Sam. It says, I left my company and have 90 days to exercise my stock options. 2 months have passed, so he's almost, he's 2/3 of the way in. The company raised over $50 million, but is not profitable and needed to raise money this quarter. There has been no news. I don't want to throw away $18,000. How do I decide if I should exercise? So you obviously, without knowing the full situation, you can't say do it or don't do it.
Yeah, but, I've seen this situation. The similar one is when companies allow employees to buy their shares up front and then vest with a buyback. But then, so it's the same situation. You're betting all your money. Here you have those 90 days. It's definitely a tough one. I have heard actually not too long ago somebody was telling me that he decided he wasn't going to put I think it was $1,000 or $10,000, and the company did really well, and he left a lot of money on the table.
Yeah.
On the other hand, it's money that it's entirely at risk. I don't know what to say other than, there are some situations, and I don't know if this is one of them. I'll say two things. One is, hopefully he's still in good terms with the people in the company, and he can get as much insight as possible about how things are going. He mentioned there's no news. Hopefully they can give him as much information about how things are looking to help him with the decision.
Yes.
And usually, most entrepreneurs, most management teams try to be helpful, unless the departure was nasty, which I don't know. But most times, people try to be helpful. To the point, which was my second point, sometimes the company has some leeway to find a way of helping out and changing the terms and so on. I wouldn't know without the details, and it might not be a possibility here, but it's sometimes a possibility. So, but yeah, it's a tough one. I don't think.
Well, especially if they've raised $50 million, you have to assume they've done something reasonably well, right? Like they've built some asset, I would hope.
Well, you know,
the company.
that brings a really good point, which is relevant here, which is I remember there was one company which was one of my best companies. They had built a great company with very little money. We had put a few $100,000 and they were doing really well. And then their competitor did a $100 million raise. And these entrepreneurs said, oh, if they raise $100 million, we have to raise $100 million. And they went on and they raised $100 million. And I was so frustrated that day, because what does that mean? That means before, if that company had a $50 million exit, everybody would have been thrilled, everyone would have been happy, we raised a little bit of money. So now when you raise 100, all of a sudden, if your exit is not in the hundreds of millions, nobody makes any money, because first you have to pay the investors. So the thing I would say to this person to keep in mind is, if this company paid 50, it has raised 50, that means that unless the exit is in the hundreds of millions, he's not going to see a dollar. Common stock are less priority than the preferred who put the $50 million. So think about, okay, is this company likely to worth, say, $500 million? If you don't think there's a really good chance the company is going to worth $500 million or more, then you might not want to exercise.
All right. Well, we have time for one more question, I think. Time is flying by. This one's from Mark. I'm a 35-year-old engineer, and I have a great job offer at a growing SF company, San Francisco company. I get a sense the engineering team is young, inexperienced, and somewhat lazy. Interesting. How do I figure out if this situation will work in advance? Thank you. So great question. Evaluating a startup before you get inside, right?
And the startup has the same challenge. They're trying to figure out, is this person going to work out?
Yeah.
I mean, the ways of dealing with that are relatively standard. One is you try to spend as much time as possible with them. And so if you have a current job, but maybe this is a startup, maybe they work a little bit nights and weekends. Now, I'm worried about this notion of them being lazy, because I think all the successful companies that I've been involved with, the teams work really hard. So I would try to get to the bottom of what this being lazy is, because that doesn't sound too good. Yeah. So try to spend time going there, figure out if they're having like a weekend session, and maybe you can take some days off your current job and go do it. So spending time, and then do reference on them. They're probably doing reference on you. So you should be doing reference on them. Talk to them, I mean, sometimes, one of the things I do for my entrepreneurs I work with is I'll help them convince candidates that they're trying to recruit that they should join the company. Yeah. And so the smart candidates will ask me, well, tell me about how it's been to work with so-and-so and so-and-so, and why do you like them, and what are the challenges? So ask them, you want to talk with some of their investors, you want to talk with some of their advisors. So don't be shy about doing a lot of due diligence. Yeah, no, that's great advice. And I would, as you said earlier, when you're making an investment, you go spend time with the investors and try and figure it out. That's really the only way, along with referencing, where you can get more data. So I hope that works out for you, Mark. Unfortunately, we are out of time. So Ariel, thank you so much for joining us today. Pleasure. Great answers. And you can follow Ariel on Twitter. He's got one of those first name Twitter handles, at Ariel, A-R-I-E-L. So go follow him. Tune in next week for another episode of FounderLine. Our guest will be Josh Ellman from Greylock Partners. Josh is an old friend, and he's worked at a bunch of great companies, Real Networks, Zazzle, LinkedIn, Facebook, Twitter. He's got the trifecta of the social networks there. He's an active investor in companies like Medium and Jelly, SmartThings, and it'll be a great show. So it's next Thursday at 5 p.m. Pacific time. Thank you once again to our fantastic sponsors, Ustream and Orrick. Don't forget to follow us on Twitter. Our handle is @FounderLine. You can send us questions during the week to help@founderline.com.
You can go to our website and subscribe to updates. We send an update every week with who the guests will be. And you can also subscribe to our podcast on iTunes. Thanks for watching. Here's to the crazy ones, and we'll see you again next week.